How's everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to bring everybody an update on open banking. I just got an article from Banking Dive, the open comments period on what is known as the 1033 rule, aka open banking rule. That just closed up, and the CFPB got hit with what is being called a deluge of over 14,000 comments from a various huge plethora of stakeholders, if you will. So I wanted to bring this article here so we could go through it and I could bring everybody this update on open banking. So CFPB deluged with open banking comments. Banks and fintechs aired their arguments regarding the federal agency's proposed revision of a rule on sharing consumer data. Now, look, I make no bones about it. I hate the open banking rule. I despise it. I do not like the fact that banks would be forced to hand over their customers' data to third-party providers. I find it repulsive. It does not benefit. Consumers in any way, shape, or form, as far as I'm concerned. I'll tell you who it does benefit. It benefits the fintechs who have been salivating for years on getting their hands on the bank data. It could benefit banks from the standpoint that if they can charge for the data, it could create a huge revenue stream for them, which, again, some banks might like. I don't think that revenue stream in and of itself, first of all, I don't think it's going to make customers very happy that the bank is selling their data, selling their information. And I'm sure, of course, I'm sure you're going to hear all this stuff about like, oh, well, there'll be opt-outs and all this other stuff. Yeah, I think, no, forget that. That stuff is all going to be meaningless. You're not going to be able to opt out of this if it goes through. So my preference would be for this whole thing to just get killed and go away. But you've got, like I said, you've got a lot of groups advocating for it. And it looked like the 1033 rule was dead in the water. And then it kind of came back. They had a court fight over it. And then the CFPB basically said, all right, I'll tell you what, we're gonna pull this back. We're going to rewrite the 1033 rule. And then we'll try to come out with something new. And thus they had this open comments period and said, okay, what are people going to come at us with? So that kind of leads us to today here. So now what do we have here? The Consumer Financial Protection Bureau collected about 14,000 comments by a Tuesday deadline suggesting how it should revise an open banking rule. Aside from the banks and fintechs clashing over how Americans may control their personal financial information, the issue drew commentary from a motley assortment of interests: advertisers, food suppliers, consumer advocates, convenience stores, credit unions, grocers, retailers, retirees, libertarians, mortgage lenders, taxpayers, and cryptocurrency groups. In a letter Tuesday, Senator Cynthia Loomis, a Wyoming Republican, called the Section 1033 open banking portion a bright spot on the 2010 Dodd-Frank Act. Yeah, I'm interested how she came to that conclusion. We cannot empower the opponents of digital assets to rewrite the rules in their favor, stifle innovation, and increase costs, Loomis wrote. Throwing up barriers would drive entrepreneurs overseas and weaken America's leadership in financial technology. Yeah, I don't know how she got there. I don't know how, selling or handing my data over to Meta or Apple or Google or whoever, I don't know how that stifles America's leadership in financial technology. So, she must have got some cheddar ching from some of these fintech companies. But anyway, I digress. Apple's payment services unit weighed in on behalf of the tech giant's digital wallet. Of course they did, urging the CFPB to retain open banking. But of course they want that. But to exclude wallets under the regulation from being considered a data provider, the same as banks and card issuers, because again, they don't need to do that. They just need the data. The CFPB opened a 60-day comment period in August to inform its revision of the rule, which is set to take effect July 1st for the largest banks. About 13,900 filings were submitted as of Tuesday night's deadline. The open banking rule was enacted last October during the Biden administration as a way to spur competition in financial services by allowing consumers to more easily transfer their information to new providers. See, that's the whole sales pitch here. Oh, it's going to give consumers more It's going to give them more control over their data. And I keep asking this question that nobody has an answer for. How does giving all of my banking data to Google or Meta or Facebook, how does that give me more control over my data? I feel like, keeping my data private in the bank is what gives me control over my data. But that's just me. Banks immediately sued to block the rule, arguing that the Bureau had exceeded its authority. Yes, of course. Why? Because what was in it for banks? Absolutely nothing. Banks had to build this backdoor portal that they called it, which would allow a third party to come up and basically plug an API effectively into the back door of the bank and siphon out the customer's information. Now, this portal would have cost banks millions of dollars to build. It would have dramatically increased their cybersecurity insurance. They no doubt, because again, external APIs are extremely unsecure. They can be easily hacked, and so there absolutely would have been more data breaches with this. There still could be if they put this through. And again, and banks could not charge for this. So there was no potential revenue stream, and yet it was going to dramatically drive up banks' costs and their risk of transferring this information. So again, there was absolutely nothing in this bill for banks. Okay. Then all of a sudden, Jamie Dimon came out and said, well, we could actually start charging for this, and then we might be okay with open banking, and then they started charging Plaid, whatever that company is. They started charging them for access to the customer data. And then the CEO of PNC, Demchek, he came out and said, yeah, if we could charge for this, we could get on board with it. And then that started to change a little bit of what was being discussed here with the open banking rule. Now, wither the CFPB. So overshadowing the rule debate, however, are comments last week from the Bureau's acting director, Russell Vogt, suggesting the agency's end was near. We don't have anyone working there except our Republican appointees and a few career employees that are doing statutory responsibilities while we close down the agency. Vaught said October 15th on the Charlie Kirk Show, we want to put it out and we will be successful probably within the next 2 or 3 months. The Bureau's press office did not respond to emails about Vaught's comments. Vaught, who also leads the Office of Management and Budget, has been trying to dramatically downsize the CFPB's workforce and mission since he was appointed acting director in February. Despite the agency's uncertain fate, fintech groups noted this week that the prior rule remains in effect. It's important to remember that even if there were to be changes at the Bureau, the existing 1033 rule is the law of the land. Penny Lee, the chief executive of the Financial Technology Association, said in an email comment Monday. However, I would challenge Penny Lee on that because it is not a law. The 1033 rule is exactly that, is a rule. It was a rule that was put forth by the CFPB. It is not a law. Nobody in Congress put forth any legislation ever on 1033. It is something that came out of Dodd-Frank. Okay, that's true. However, nobody in Congress put through any type of legislation on this. This is not a law. This was a rule that was put forth by the Biden administration, CFPB, and it was a patented government overreach from day one. And they put it through there, and this can be extinguished just as easily as anything else. This is not a law that needs to go back in front of Congress and needs to get repealed or anything. That is not the case. But of course, she's representing the Financial Technology Association, and of course, they have a vested interest in getting this through because they want to get their hands on all our data. So of course they want this. The open banking matter is also the subject of a lawsuit banks brought last year in a federal court in Lexington, Kentucky. In July, U.S. District Judge Danny Reeves agreed to stay the case after the Bureau said it would revise the rule, telling the parties to update him every 45 days. In its last update on September 12th, the Bureau said it would consider the public comments as it develops a well-reasoned approach to implementing Section 1033 that aligns with the policy preferences of new leadership and addresses the defects in the existing rule. Now, what are the policy implications here? So in its 22-page letter Tuesday, payment processor Stripe said the CFPB's decisions on open banking will affect the evolution of agentic AI commerce and carry profound impacts on whether stablecoins can fulfill their promise for reducing frictions in the payment system. Wow, that is a stretch if I have ever heard one. So in other words, the Meta and Google being able to get their hands on my data is going to affect the development of agentic AI. That's a new one. I hadn't heard that one yet. It's gonna affect stable coins too. Stable coins are gonna go down in a blaze of glory if they can't get their hands on my data. You know, you got to be kidding me with this. These are significant shifts in the payments ecosystem that will drive further innovation of financial services unless they are asphyxiated by fees and other anti-competition restrictions imposed by incumbents, wrote Jonah Crane, Stripe's head of global regulatory and policy development. So what that means is that Stripe not only wants the data, they want it for free. They don't want to pay for it. Okay, they expect your data for free. Unreal. The three main fintech associations, the American Fintech Council, FTA, and Financial Data and Technology Association North America, filed a joint comment with four other industry groups. The associations urged the Bureau to retain a prohibition on fees for data, of course, like I said, because they don't want to pay for it, adopt a definition of consumer representative that doesn't require a fiduciary relationship, and maintain current 2026 compliance deadlines. Yeah, that would be no, no, and no. We cannot allow a select group of the nation's largest banks to dictate the future of American financial services, the letter reads. What about the consumer? Those banks hold the consumer's data. What about the consumer? That's what I love about this whole conversation, is that there is nothing about what the consumer wants. It's all about what the fintechs want or what the banks want. There's nothing in here about what the consumer wants. Nobody bothered to ask the consumer, which is wild to me. The Electronic Transaction Association noted that the payments industry is genuinely divided on critical aspects of the rules provisions, including within its own membership. As a result, the Bureau should convene an industry roundtable to hear directly about operational implications, identify areas of potential consensus, and reduce litigation risk by demonstrating thorough consideration of stakeholder perspectives, wrote Patrick Russell, the ETA's Vice President of Government Affairs, in a letter. Of course, that's what they want. JP Morgan Chase, the largest U.S. bank, filed a 23-page response separate from its trade groups. The bank came under fire in July when it rolled out new fees for fintechs to access consumer data. Oh, the horror. Fees will let the market determine the value of services, supports ongoing maintenance and improvements in essential infrastructure, discourages unnecessary data collection, and motivates aggregators to prioritize secure practices over quick profits, JP Morgan Chase told the Bureau. In its letter, MasterCard was largely supportive of the current rule, but urged the Bureau to craft more specificity about data terms and usage in the new rule. The card network also said regulators should set standards for denial of access based on information security concerns. The American Bankers Association used part of its 29-page letter to implore the CFPB to suspend the mid-2026 compliance dates for the current rules, citing the agency's rulemaking and the district court's stay of the litigation, but not the rule's deadlines. The personal data rule was overbroad and built on a dubious legal foundation, ultimately picking winners, fintechs and data aggregators, and losers, banks and consumers in the process. Ryan Miller, an ABA vice president and senior counsel, wrote Tuesday, the rule simply cannot stand either as a matter of jurisprudence or policy. Yes, thank you. Thank you, Ryan Miller. Absolutely astute observation there. Just what I was saying. The personal data rule was overbroad and built on a dubious legal foundation, ultimately picking winners, fintechs and data aggregators, and losers, banks and consumers. So the current rule is set to take effect for the largest banks on July 1st, 2026, with compliance deadlines for other banks layered throughout 2030. Financial institutions with less than $850 million in assets are exempt from the rule, which affects a majority of community banks and credit unions. Banks are asking Reeves to stay the 2026 compliance dates, while fintechs argue they should remain in force. In its letter, the ABA also said the Bureau should scrap the current rule's size exemption for smaller banks. The Retail Industry Leaders Association also weighed in, urging the Bureau to prevent data providers from assessing data access fees on consumers or their representatives. RILA represents large retailers, including Costco Wholesale, Guitar Center, and Walmart. Scant competition in card payments has caused bloated fees that every U.S. merchant pays today when accepting credit and debit cards, wrote Austin Jensen, an RILA senior executive vice president, in the letter. Allowing a new version of an interchange fee for open banking will only stifle innovation and lead to the same consolidation in the market, Jensen wrote. This same scenario has played out over the past several decades with credit and debit cards, and RILA implores the CFPB not to take the same path. I don't agree with that at all. So again, if it's going to happen, there should be a fee for it. None of this should be just give it away for free. Why? I mean, from a banker's perspective, from the banking perspective, banks have spent decades building this client information. Why in the world would the bank just hand it away for free? That's ridiculous. And then you end up in the same arena that commercial realtors are in with CoStar, where basically they send all the information to CoStar, and then CoStar charges them to get the information back, all the data that they just gave it to them for free. Like it's crazy. I feel bad for commercial realtors with the whole CoStar issue. That's a whole another issue I need to cover in another episode. But anyway, so the open banking debate continues. Again, I have made no bones about my opinions on this topic. I want the open banking thing to die and go away. I'm hoping with any luck that if the CFPB does get shut down, that maybe it will take this open banking rule with it. But I don't know. This thing will probably hang around and linger. You got a lot of parties fighting for it, especially the fintechs. I think banks might get okay with it if certain things can be changed or provided to them. But the fintechs got to understand here, they're not winning this argument. Okay, if they don't give something to the banks, i.e., fees, a revenue stream, if they don't give something, they're not going to win the banks over, and they're going to get nothing at the end of the day. So again, I think that some sides need to bend here if something is going to happen. But like I said, I'm hopeful. I hate this whole thing. I want the whole thing to go away. I think it's utterly ludicrous. And that's just how I feel about it. So, okay. So hopefully this provided people some update on the open banking rule. We got to give them time to digest all these comments, and then we'll go from there, and we'll see what happens over the next few months. But anyway, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, and I would love to hear what people think about this one. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. Have a great day out there, and I will see everyone again real soon.